let's look at the practical, how we are going to post the transactions identified into the two control account, which is receivable control account and payables control account, based on double entry principle. Number one, let's look at the account receivable balance, but the emphasis here is DR. DR here means debit balance. Debit balance. Debit balance means we are going to take this balance in the debit side without hesitation. I told you that this is what's called identification. The question already identified that this balance is a debit balance. So without wasting time, take it to the debit side. As you can see, this is balance. The title is balance brought down. The amount is there, which is 196,520 naira. Then the next is account receivable balance, but in this case, it is a credit balance. A credit balance, meaning take the balance to the credit side of receivable control account. As you can see, the title is balance brought down, which is 4,740 naira. So the two balances in the receivable account have been posted respectively based on the identification of debit side balance and credit side balance. But this is where I want to say that if the balance in the receivable control account is not identified as a debit or credit balance, a single balance will be given. A single balance will be given. And if a single balance is given and DR or CR is not identified as in this question, this is where you go by the principle. It means take the balance to the debit side of the account. Why? Because balances brought forward of all assets are debited. Account receivable is an asset, and any asset that is brought forward or brought down is always debited. So mind you, if the opening balance of account receivable is not identified, a single balance is given, and you must take it with authority in the debit side or receivable control account technique. Now, let's go to payables. Payable balance is here as credit. Then without wasting time, already explained, take it to the credit side as identified. Look at it here, and the title is balance brought down. Look at it here, 144,380 naira. Next, the account receivable balance here, it is a debit balance, as you can see, debit balance. So also take it as identified as a debit balance and put it in the debit side. The title still remains balance brought down, which is 8,420 naira. Just like I explained, the case of account receivable, if identified, post as identified. But if not identified, in case of account payables is a liability. And balances brought forward or brought down of all liabilities are credited based on the principles of accounting. All liabilities brought forward or brought down are credited. So if the balance is not identified or indicated in this way, only single balance will be given, and there will be no issue of, or there will be no debit or credit identified. So in that case, mind you, take the balance with authority and post it in the credit side, and it will be 100% correct. Let's go to the transaction during the period. First, we have credit purchases, which is going to payables control account. This is where you apply the principles of double entry very, very careful. Here, if you talk about credit purchases, all purchases in accounting are debited. Be credit purchases, be cash purchases, be bank purchases, any purchases in accounting is debited. Meaning that all purchases are debited because they are receivers. So if purchases is debited, it means the corresponding entry in the payable control account will be credited. So here is strictly based on double entry principle. All purchases are debited based on principle. The corresponding will go to the credit side. So look at it here. Credit purchases is now credited because it's debited in the ledger based on principle. Let's go to the next one without wasting time. It's clear. I'm saying that we are strictly using double entry. Don't know double entry. Go back and follow my lesson carefully. I've explained double entry to the lowest level. You will understand and come back and understand control account very well. So next, credit sales. Credit sale goes to receivable control account. Mind you, sales is revenue in accounting, and all revenue in accounting are credited. Be it credit sales, be it credit purchases, be it credit sales, be it cash sales, any form of sale or by bank is credited in the ledger account. If sales is credited, coming to the control account is a corresponding entry, then you post it in the debit side. As you can see, credit sales amounting to 1,563,080 naira clear, posted based on principles of double entry. Any debit entry must have a corresponding credit entry and vice versa. Here we have sales ledger set off against purchase ledger. Here it is like contra entry, which have a credit posting in the sales ledger and the debit posting also in the purchases ledger. So here, by way of principle, in set off, if you go to receivable control account, you post it in the credit side. If you go to payables, you post in the debit side the same amount. Meaning that if you talk of balances in sales ledger, they are in the credit side. So if there's a set off, it means the balance in the credit side of sales is being set off against the balance in the purchase ledger. And that's why in terms of set off, it means you are going to credit receivable control account always, and then debit payable control account always. Anytime you see set off, take it, and that is just it. Then we quickly go to, let's start with receivable control account. Look at your set off here in payable. Look at it in the credit side. So anytime you see set off or sales ledger against purchases or purchase against sale, anyhow you see it, it means in the receivable control account, post it in the credit side. Then the same amount, come and post it in the debit side of purchases. As you can see, that is like contra entry in the cash book, and that is how it is settled. But I want to explain something here, that we have what is called transfer. Transfer here is different from set off. Set off, it means one balance in another account is being cancelled or by another balance in the purchases. But transfer, it means moving something from one account to another. In this case, the opposite becomes the case. As you are moving, you are changing position. So if it's transfer in receivable control account, debit it, while in the purchase control account, credit. So mind you, if it's set off, do as I explained, but coming to transfer is the opposite. In transfer, receivable control account is debited with the same amount, while purchase account is credited. Take note. So watch out in case it is transfer. Then last, we go to these receivables dishonored. Being receivable dishonored here is going to receivable control account. I earlier explained what is a B. A B means a payment, a credit purchase, a credit sales that have been scheduled to be paid at a given date. So when the date matured and customer failed to pay, it becomes a dishonored B. And that is why it is here explained earlier. Then how do you understand the double entry position? Anytime a B is being drawn on customers and accepted, it means a debt has been created. And that debt is found in the debit side. That debt that is created is found in the debit side or receivable control account. So if the B is now dishonored, means the debt that has been created will fire out in the credit side. So it is a credit side position, which is the dishonored position that I was talking about here. So the opposite of the dishonored position in the credit side will be debited in receivable control account technique. So here, look at it here. B's receivable dishonored is debited. I already explained that when the B was created, a debt was established and the account was debited. When it was dishonored, it was credited. It's a credit position that we're doing the opposite in the debit side of receivable control account, as you can see it here, and that is how it is recorded. Next, we have cash purchases. Sorry, cash sales, I mean to say. Cash sales here is a foreign item, leave it and move ahead. Next, we have bad debt written off. Bad debt written off here is an item in receivable control account, because bad debt relates strictly to account receivable. Bad debt is an expenses in accounting. And the fundamental principle in accounting is that all expenses are debited because they are receivers. So if bad debt is debited in the ledger, the corresponding will be credited in receivable control account. As you can see, look at it here. Bad debt being credited because it is debited in the ledger account. The corresponding entry will now be credited, as you can see, 10,520 naira. Next, it is bill of exchange drawn on customers. Here you can watch it clear. Bill of exchange drawn on customers, it means the customers have accepted the bill. Now that the customer has accepted the bill, it is not dishonored. Therefore, a debt is being created and that debt is debited. That debt is already debited as an item in the receivable control account of that particular customer, which name will be on the account. So if the debt is created, the opposite of that transaction will now go to the credit side of receivable control account. As you can see, B is receivable, and the amount is 69,460. That's why I told you that the double entry understanding becomes a key in financial accounting. Next, bills payable or not. Bills payable or not here is a foreign item. I've already explained that any bill that is honored, it means at the maturity date of that bill, the customers have paid. The customers have paid. In this case, it is a business. When the bill matured, the business paid on the agreed date as it was supposed to be paid. So it's as good as cash purchases. And that is why it becomes a foreign item which is not to be recorded in the account. Let's proceed quickly. We go to returns inward. Return inward relates to receivable. Return inward in accounting is debited. As you can see, all goods returned are debited. All goods returned by the business are returned by account of business are debited. So if they are debited, the corresponding entry will be credited in the receivable control account. As you can see, returns inward. Look at it here, 14,900. Without wasting time, here is return outward. All returns outwards in accounting are credited because goods are going out. Debit the receiver, credit the giver account. So here as goods are going out, it becomes the giver account. So if return outward is credited, you now go to payables control account, which will now be debited. As you can see, perfectly double entry position, 17,840 naira. Next, we are talking about cash purchases. Cash purchases is a foreign item. No much explanation I have explained over and over. Next, we go to cash received from customers. If cash is received from customers, it simply means that cash has been received from the customer, the cash book or the cash account will be debited. Simple. Cash is received, the receiver account becomes the cash book or cash account will be debited, and the corresponding will be credited in the receivable control account. Look at it here. Cash received from customer, which is 1,378,460 naira, and it is correct. Next, cash paid to suppliers. Cash paid to suppliers simply means the business is paying cash to suppliers and money is going out to the business. If money is going out, credit the account that gives me, cash book will be credited, while the corresponding will go to payable control account, which will be debited. As you can see it here, cash paid to suppliers, 990,280 naira, perfect double entry. Next, you go to discount received. Discount received in accounting is revenue. All revenue are credited, as I said, in case of sales. Sales is the major revenue the business is credited. Discount received also revenue is credited. So if discount received is credited in the ledger account, the corresponding will be debited in payables control account. As you can see, discount received 38,640 naira without issue. Next, you go to discount allowed. Discount allowed is expenses. All expenses are debited in accounting with authority, and when they are debited, the corresponding will be credited in receivable control account. As you can see it, discount allowed, 49,500 naira. Next, we are going to cash refund to customers. Cash refund to customers, here I'm saying, try to understand the double entry position. If cash is refunded to customer, it means money is going out. Money is going after the cash. The money is going after the cash. The corresponding will be debited in receivable control account. You can see cash refund to customers, 2,540 naira. Now, the transaction during the year have been perfectly recorded in the respective side of the control account, which is the major area of control, understanding which side the items are posted become the key here. Now, let's go to the balancing. The requirement is clear that you should prepare this account. We have prepared the next you have to balance. In accounting, all accounts are balanced at the end of the accounting period. So here, to balance the account, I want to explain something that most learners don't know. Here, if you look at the question, we are going to introduce the balances carried down here. The balances carried down here is introduced.